Hi everybody, Jeff Yastine here. I hope you're having a great Thanksgiving holiday weekend. As always, send a comment or question to me, jeff@yastine.com. And also, again, feel free to follow me. Would love to see you follow me on Twitter and on Facebook. So let's talk about last week's stock market because, again, this being Thanksgiving or Thanksgiving weekend, certainly there's a lot to be thankful for with the market because it's giving and giving in the way of profit because it seems like everything's getting pushed higher and higher through the middle part of last week. So I want to put that in perspective though, because quite often when you see these huge moves, you have to be prepared for something else on the other side. Often there's a cost. Often there's a hangover, if you will, that comes with big extreme moves to the upside. In the same way we can see it when we have big extreme moves to the downside. And we've seen plenty of that this past year as well. So this chart that I want to show you, the CBOE put-call ratio, to me, says it all. And here it is. This is the CBOE put-call ratio. And what it's measuring, essentially, is investors and speculators and their bullishness or bearishness in terms of how they position themselves in the options market. And this is just sort of a typical way that things go as speculators become more and more emboldened. Of course, they buy more and more options, and this is just a way to measure just how extreme in some cases, and this being a prime example of it, where perhaps, just perhaps, there's way too much optimism out there. And obviously a lot of this is being driven by both the COVID vaccine news as well as heading into a major holiday like we're seeing. But we still have another month to go before the end of the year. We still have some time here before a decent amount of the population is going to be experiencing the COVID vaccines, which of course is good news. The problem is we're still in the middle of a major pandemic, which may well get worse in terms of people getting together for the holidays. It's just one of those things that we're having to deal with. And of course, the market is going to have to deal with that as well. And let me explain why I am concerned about that, why I'm kind of raising a bit of a warning flag here. As we finish out November on Monday, November's it's the last trading session, and obviously then look to the last month of the year. And this chart for the Nasdaq kind of says it all. Now I'm taping this on Tuesday afternoon, but you can see where we have this sort of pending breakout in the Nasdaq, and typically you would look at this and say, let's buy it because it's going to keep going. And in many ways we can confirm that by saying, well, look at the Russell 2000, which is what we're looking at here. This red line shows us the old all-time high for the Russell 2000, which was back in August of 2018. And now we have this, this huge breakout. Maybe it keeps going. On the other hand, if you were a Wall Street trader and you have millions of shares that you're trying to slim down in your portfolio, take profits on, etc., without moving the prices too much, the best point to do that is in periods of let's call it maximum liquidity. And often the way that will happen at critical turning points for the market is you will see basically what I call a pop and drop. The market will appear, and again, I'm talking the major indexes here, appear to break out the new all-time highs. Meanwhile, smart institutional traders, again, with responsibilities for their portfolios, will use that point of maximum liquidity as everybody goes in to buy the breakout. They will use that to sell and be able to reduce their positions in a lot of the biggest, tech stocks and all the stay-at-home stocks, everything that's worked over the past 6 months. They use that to be able to basically liquefy their positions and get cash without pushing prices down too much. So that is a chief concern of mine. Now, I could be completely wrong. Maybe the markets just keep going higher here. I mean, we saw something very similar to this in 1999, where from October of 1999 through March of 2000, basically the NASDAQ went straight up. And yes, that was or did mark the end of the dot-com boom or bubble, if you will, and the beginning in March of 2000, the beginning of the dot-com bust. But in the meantime, you had 4 or 5 months of basically straight up movements in stocks, if you own the right stocks. And maybe that's what we're looking at now. But my concern would be, if you look at Wall Street as your adversary, and it is sort of an adversarial game, well, going to selling into a point of maximum liquidity would be a key point that I would be looking for if I were a Wall Street trader, and trying to make sure that I can get good prices for my FANG stocks and for Tesla, which I probably have ridden up for many, many points, up to the point that Tesla was added to the S&P 500, which again can also be a sign of a top when you see a major stock moved into a key index like the S&P 500, as Tesla has become part of that group of the 500 biggest, best, most representative stocks of the U.S. economy. So I just want to make that point to you. The fact is, I could be completely wrong. All right, this is just an instinct of mine, and maybe by next week we'll all laugh about this and say, ha ha ha, Jeff was wrong on that, and I hope I am wrong. But at the same time, you just have to remember, this is an adversarial game, and that the points where you feel most confident, you feel most greedy, for lack of a better word, are often the points that Wall Street uses against us. And if you have any doubts about that, go back and look at the put-call ratio that I was showing on my screen just a moment ago. So something just to keep in mind here. And if you like what I'm talking about, make sure to subscribe, like us, and follow me on social media. I'm Jeff Yastine.